Jeremy, Bitcoin is a way that replaces currency. And I'm like, that makes no sense at all, because we have plenty of currency, and a volatile asset that goes up and down is not a good system for a currency, right?
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, Sierra founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
In general, VC as a startup, every startup founder kind of believes the blue ocean in that sense. So what I mean by that is every startup founder is saying, I'm building something new that the world doesn't exist. As we talk about the world perspective from a VC perspective, because red ocean means, for those who understand, red ocean means it's highly competitive, there's a lot of similar companies, there's a lot of incumbents, you're competing with them. Blue ocean is you're creating a new category, you're creating a new space that has very little competition. But I can tell you that almost all founders think they're blue ocean. Does it make sense? So there's a self-awareness part, right? And so from a VC perspective, we're judging that. I think to directly address your question here as a result is, what happens if a founder thinks they have a red ocean product? It's pretty unlikely because, again, every founder thinks, they're like, man, a bakery with Bitcoin, of course, this is a blue ocean product. We accept Bitcoin. There's no other bakery that accepts Bitcoin, and now we do. And I think it's a joke, but then we saw that quite a few of them pop up, right? In Singapore, like, we're differentiated because we accept Bitcoin as a point of payment. But then from a VC perspective, external perspective, a lot of people are like, hey, but actually, accepting Bitcoin is a feature because you're still a bakery, you're still a food place. So you never escape your competition. It's a cool thing they added onto it, right? So yeah, I think if you're a startup founder and you know that you're red ocean, you probably will be like, you should accept money that's from like family offices, from private equity, from slower rate of growth, because you still can make money in a red ocean market. It's just that your rate of growth is going to be slower. Does it make sense? But also, so in general, a red ocean market means, but if you're the best in that red ocean, it just means that you eventually make money, but you make money slower. And then as a result, you're forced to be more efficient over time. Yeah? And then the second thing is that from a blue ocean perspective, is that we want to make sure that we are thinking about portraying yourself and explaining the blue ocean. Because VCs, after seeing a lot of red ocean companies, tend to over-index and say everything is a red ocean thing. So they get very cynical and jaded. So if you read the ocean thing, actually what happens is that people are very bad at explaining why this is a cool thing. When people explain Bitcoin to me back in the day, and I never got a Bitcoin chain, and everyone was like, Jeremy, Bitcoin is a way that replaces currency. And I'm like, that makes no sense at all, because we have plenty of currency, and a volatile asset that goes up and down is not a good system for a currency, right? Because for currency, you need a when you have currency, you need a court to protect your currency, because otherwise people steal from each other, blah, blah, blah. And in order to have a court, you need to have military force to back up your court. Otherwise, you have a useless, powerless court. Who cares about some random island's court system that says Jeremy needs to pay back this person for that? I say, forget about it. I don't care about this thing. I'll just continue living in Singapore because there's no territory. But now, obviously, what we see is that Bitcoin has got to the point where they say they've gotten enforcement court actions from Singapore. So it was supposed to be a global currency that no government was part of, but now they asked who? They asked the USA to bail out and liquidate and force the creditor claims for FTX, right? And so now they're going to pay back about 110%. Sam Bankman-Fried, he is in a US prison right now, all right? So again, this global currency that had no government, to me, when they explained it to me, I said, it makes no sense. So I was 100% correct. I said back then, Bitcoin will not work as a currency because at the end of the day, it will be something that has to work with the government in order to protect itself. However, I was wrong. What someone should explain to me was like, say, hey, Visa and MasterCard take a ton of money as a gatekeeper, all right, of the transaction fees, taking 5%, 10%, whatever it is. If you try to walk from Singapore to the Philippines, they're trying to take 20% of the fee. With Bitcoin, that cost will go to zero, because for the first time ever, if I send you a JPEG, then you can copy paste 1 million of those JPEGs. You know, that's not currency, right? Because you can adulterate the currency, you can clone and cheat. But now when I give you 1 Bitcoin, you know that you receive 1 Bitcoin, I definitely minus the way 1 Bitcoin. So this is a way to it's a good way to transfer money. Now, if somebody explained to me back then, I would be like, bam, I'll be the best crypto bro since 2008. But too bad, nobody explained to me. Everybody was talking to me about this utopian world where everybody uses Bitcoin and nobody goes to see the government anymore. And I was like, that's not my thing, right? So for me, I made a mistake. I didn't understand crypto from that perspective, right? And so right now we see crypto is often used for regulatory arbitrage, right? So we're like, hey, we want to transfer money from point A to point B without paying this or that. We see a huge amount of that happening. Hopefully that helps. Blue Ocean, the Red Oceans, VC founders must learn to grow slower and more capital efficient and understand their Red Ocean. True Blue Ocean founders have to translate and explain to people why it's a true Blue Ocean, because VCs are very jaded people. We're now going to go into the VC fundamentals. The first VC came to existence. His name was George Frederick Doriot. He is called the father of venture capital. So in 1946, with this company called American Research and Development Corporation, he would later found INSEAD, our wonderful MBA school that is in Singapore and France, in 1957. Okay, so small world here, right? And what was interesting was that in 1946, he founded this company because World War II had just ended. So the American government said, we want to help people who are returning from the war, soldiers, to set up new businesses. So we want you to administer loans and other financial support to these businesses so they can set up the businesses that they want. And Silicon Valley came to existence around this time frame. Silicon Valley didn't exist during World War II, but after World War II, it had a hub. He had great universities, he had a defense spending, he had a wonderful climate for people coming back from the war, who were all coming back to set up businesses. And he only struck it rich, in that sense, with the first VC investment in 1957. So he was deploying capital for about 10 years in a row, right? And he invested $70,000 in this company called Digital Equipment Corporation, Mini Computers. A computer was the size of a whole room. So this whole room would be considered mainframe, right? And then they created something called the mini computer. So the mini computer basically was the size of a fridge, okay? So they created this crazy idea, which is, why don't we take all the computing power in the room and make it smaller and more accessible with a fridge-sized thing that you can park it next to your desk. So this company, eventually, in 10 years' time, eventually would have a $38 million IPO. So they didn't raise a lot of money, and $38 million sounds very small, but they didn't absorb a lot of capital along the way. And as a result, that $70,000 check created 500 times return for this check, okay? Another way of saying this is that basically that $70,000 check doubled every year for 10 years. So $70,000 check became worth $140,000, which became $600,000, became 1.2 million, 2.4, and it just kept growing like that for 10 years in a row. And that's an interesting story. So that check was a type of the company that started to come to existence, because this was the same time that all of this technology, all of the R&D that went into World War II for encryption, for computing, for fighting the Germans, Japanese, all that computing power was starting to be converted for B2B and B2C purposes instead of industrial warfare purposes. And fast forward another 20 years, eventually this would lose to microcomputers. So this was called a mini computer. A microcomputer is the kind of computer that's in front of you. The computer in front of you is, by their standard, is called a microcomputer. Okay? But what's interesting, of course, is that we're now going back to mainframes. The world goes back cyclically. We're going back in time. If you use ChatGPT, it's being done in a data center, right? So a mainframe, which is a giant data center. So it's a kind of interesting piece here, which is, there's always this idea, which is, do we want to decentralize computing power so that all the computing power can be done in this computer that you have? But if you use ChatGPT, all that search is being done by a mainframe, a data center that is in the US with all these GPUs, etc. We're going back to that world where the hub is very strong and your computer is a dumb terminal, is only an output pool graphical version of what's actually being computed somewhere else. As we talked about, is that if you do a Google search right now, not even an AI search, a Google search has the same amount of processing power as what was needed to send the Apollo mission to the moon, okay? So every time you do a Google search, you're like, wow, I sent a whole mission to the moon. And that's only about 20 plus years ago, not that long ago. So this guy caught the first wave of technology companies. And now today, capital is considered to be a profession. So back then, nobody knew what was going on. He did it, And he was like, wow, I was lending money and helping all these servicemen, but suddenly I'm making a ton of money. And then it took a while for people to understand what's going on. But today, VC is now a well-known profession. Obviously, we have institutions like sovereign wealth funds, Temasek, you have your Dubai, the Saudis, etc. Obviously, you have venture capital, which is focused on high-speed growth. Obviously, some of you want to do private equity and growth equity in your banks. And then we'll talk about that. And obviously, we have the public equities, right? The public stock market, where everybody can invest. You and me can invest using Robinhood or some kind of day trading app. And so what's important for you to know is that for those who are a little bit more financially oriented, a public equity is that this company is full of public information, and I can invest in Apple or who are the other public companies? GoGrab or GoTo. All those financials are public right now. I can invest in them. Private equity means that these companies are private. The information is private, the financials are private, their growth is private, the team is private. There's a lot of proprietary information. So private equity companies make money because they're taking on medium risk. What they're saying is, I see a company that's privately information, but here's my secret, right? And I used to work with Bain Capital as part of the Bain Management Consultant. What the Bain Capital team knew was that even though nobody really understands this company, we know that this company can become 2 to 3 times more valuable, right, in the next few years. Because there's opportunity, or we can do mergers, or we can use debt, whatever it is. But from their perspective is, there's a lot of upside that can be created if we take control and buy over the company, and then we do all the changes that the previous management was not willing to do. And so as a result, private equity will own the majority of the company, normally at least 51%, if not all of it. And then they will try to basically buy over it to make sure they have control. And then their goal is to target about 15% annualized returns. Okay, so that's the target for private equity. Then for venture capital, is that we are considered to be high risk. So we're going to make 20 investments, which is different from private equity. Private equity is maybe doing 2 or 3 investments, right, per vehicle. And then we expect only 1 or 2 of these 20 companies to generate 20 to 100x returns. So huge return profile. So again, private equity is you buy 3 companies, and each of them will grow 2 to 3x. But you don't expect any of them to fail. If any of them fail, you're fired. And venture capital, we expect 18 or 19 out of 20 to fail. We don't expect 1 to succeed. And we normally take a minority investment. We only take 20% of the company. So we're basically saying we don't overthrow. We believe that the founder, whoever he is, no matter whether he or she is young, we expect that person to run this company during this time frame. And the goal is that we can target 25% net return on an annual basis. And what I'm trying to explain here is this, is that when we talk about private equity or most investments, most of you will look at it from a normal distribution, right? Half will perform above average, half will perform below average, and maybe 10% will perform really well and 10% perform really badly. So this is how most things happen in life, right? Maybe you show that for height, you show that for weight, you show that for whatever it is. But what's very different about the VC life is there's something called 80-20. So it's called the power law distribution, which is that this bell curve demonstrates the distribution of it, but not the outcomes of something. So for example, we said most startups actually look like this. If I put all startup performance, it will look like a bell curve. But the thing is, only this 5% of startups will become billion-dollar companies. And then these companies will generate, a small number will become $10 to $100 million worth companies, and the rest will just be zeros. Does that make sense? So what I'm trying to say here is that this represents that. And so most of you, when you go to consulting or finance, a lot of you will be trained to use the 80-20 rule, which is if you look at customer complaints, right? Most people who go to a restaurant, they experience like this, half above average, half below average. But 20% of people will generate 80% of complaints because only people who are very frustrated or very used to complaining will generate most of the complaints in the system. So something to be thinking about is that power law basis. And so what we're trying to say is that VCs are really looking for home runs. We're not trying to look for people who are average, above average, excellent. No, we're looking for the best. So we're looking for companies that have a high growth rate that can return between 10 to 200x. Reasonable valuations, if I can come in earlier and cheaper, if I can pay $750,000 to buy 20% of a company instead of $1 million, I'll take it, right? And so that's why VCs work hard to talk to founders early, because they want to make that early investment when you need more capital, right? For example, Sequoia invested $60 million in WhatsApp in 2011 and 2012, and Facebook acquired WhatsApp, which then had $450 million, 40 users in 3 years. So they invested in 2011. In 3 years, they got 450 million users, and they were growing about 1 million users per day, and they got $16 billion for the acquisition. Okay, so Sequoia, as a result, earned $3 billion from $60 million. Okay? But basically, a lot of it was in Facebook shares, which also went on to grow a lot as well, right? And so basically, this generated 50x returns in 3 years, right? So that's quite a cool amount of money if you think about it, right? You put in $60 million, and then you get $3 billion back. Pretty cool. So I think a lot of people really like this thing, and that's why people find like they get excited because they're like, wow, I want to be a VC. Who wants to be a banker? Who wants to be a private equity person? I want to be like Top Gun. I want to be the fighter pilot that looks for these home runs rather than looking for sleepy coal businesses that need to have cost efficiencies. So the way to think about it as a result is that VCs have 3 major roles that you should think about. That are the limited partners, the general partners, and the startups. Okay? So every VC fund has limited partners. These are the people who put money into VC funds. So I'm an LP in 2 VC funds. I put money into these VC funds. Both of them are focused on Y Combinator startups. And the reason why is because I don't have time to meet all the Y Combinator startups. I'm not based in San Francisco. I can't meet them. I don't feel like I'm smart enough to assess which one is the best one a lot. So I've invested as a limited partner, and I have limited legal liability. So even if things go wrong or there's fraud or whatever that happens, it's not my fault. I only put money into the VC fund, right? And me and a group of all other LPs basically put in 99% of the capital. So assuming that this is a $100 million fund, we put $99 billion of capital into there, and then the partner in the VC fund is expected to put 1% as a GP commit. So they expect to have some skin in the game as part of the VC fund. Now, the general partners receive this money and they have unlimited legal liability. So in other words, they are in control of the investments. I expect them to do the due diligence. I expect them to do their work. I expect them to work hard and make sure they govern the companies well. And these general partners are being paid about 2% of this fund. So what I mean by that is I put in, the fund has $100 million. The GPs will, as part of their management fees, get to deploy $2 million as part of their budget every year for 10 years. So out of the $100 million, you can imagine they get $2 million budget per year to help them run the fund. And then when they invest, and let's say we talked about Koi example in WhatsApp, when that large growth happens to it, when there's uplift, 80% of it will go back to the limited partners, and about 20% will go to the GPs for running the fund. So it's like a commission structure, basically. So a lot of you will go into the finance world, a lot of you will hear the phrase 2 and 20, and that's very much the standard norm. So private equity funds, VC funds, you hear that all the time, 2 and 20. But it basically means I get 2% every year of the total sum to help me run my expenses for 10 years, and I get 20% of the upside. And then eventually out of the $100 million, that gets deployed into 20 startups, right? And then 18 will eventually close or go home, and then 1 or 2 of them will become a unicorn. And then when the money, and they exit successfully, and they make lots of cash, then the money goes back to the GPs, and the GPs give the money back to the limited partners. So that is the structure of these VC funds.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.